and we'll be presenting on the topic Forex management by corporates.
Very
So
good.
let's start by an introduction to Forex risk management.
Okay.
So Forex risk management is a crucial set of strategies and techniques employed by the traders to minimize potential financial losses in the dynamic foreign exchange market. Inherent to Forex trading are various risks, including market volatility, economic events, and geopolitical factors. So the unpredictability of the foreign exchange market highlights how important it is for traders to effectively manage risk in order to safeguard their investment and prosper. Here are several key important components of Forex risk management. Next slide, please. Next slide.
Sarthak, next slide. Viraj is presenting.
Viraj, please. It's fine. I'll continue. He'll switch. Yeah. So here are the key components of foreign risk management, Forex risk management. First is position sizing. Position sizing involves determining the right size of a trading position, taking into account both risk tolerance and the size of the trading account. It is important to avoid over leverage, which can amplify both profits and losses. Then there's stop loss orders. These are vital tools to automatically exit a trade at a predefined price level. Traders set stop losses based on technical analysis, support or resistance levels, or a percentage of their account balance, providing a safety net in case the market moves unfavorably. Then there's risk reward ratio. So before entering a trade, it is crucial to evaluate the potential profit against potential loss. A common guideline is to aim for a risk reward ratio of at least 1:2, ensuring that the potential profit is at least twice the potential loss. Diversification. Then by spreading the investments across different currency pairs, traders can mitigate the impact of a poor performing trade on their overall portfolio. This helps avoid concentration in a single position or asset. Then there's monitoring and adaptation. So successful traders regularly review and adapt their risk management strategies based on changing market conditions, news events, and their own performance. Flexibility is key in adjusting position sizes or risk levels as needed. Then there's use of leverage. While leverage can amplify gains, it should be used cautiously. Traders must understand margin requirements and the potential implications of leverage trading on both gains and losses. Then there's risk assessment. Traders need to assess the overall risk of their portfolio by considering the correlation between different positions. Calculating the potential maximum drawdown ensures alignment with the trader's risk tolerance. Then understanding market conditions. Traders need to be aware of the economic indicators, central bank decisions, geopolitical events, and other factors impacting the currency markets. Adjusting risk exposure during periods of heightened volatility is crucial for success. So I would like to summarize this topic by saying that successful forex risk management involves a combination of these strategies tailored to the trader's individual preferences, risk tolerance, and trading style. It is an ongoing process that requires continuous evaluation and adaptation to the evolving market conditions.
Okay. So was your slide, huh?
Yeah. Yes.
Okay, fine. So, okay, go ahead. Now, who is the next one? You're going to present the second one also?
Yes, sir. Sir, I'm Sarthak. I'll present the introduction to derivative instruments.
Parth, just coming back to you, you have presented all these, parameters. So you have well understood them. I mean, you have been trading, or you have some knowledge about that, or from where you gained all those things. I mean, it was just Google search, or you have some practical.
I don't personally trade. I got to know about all the trading things. This was my first FAC course where I got to know about trading and all, and it intrigued my knowledge, and I had researched about it quite a bit, and Google helped me a lot. So I'll start trading also in some time.
Okay, so you could understand all which you have presented. Understand each of the issues which you talked about.
Yes, sir.
You could understand. Relate to the subject what we studied. Okay.
Yes, sir.
Yeah, now Sarthak, please, Sarthak.
Yes, sir. So, sir, I'll be introducing you to derivative instruments. So, basically,
so one thing, Sarthak, like you have just opened your video. So, whosoever is presenting, he should be, his video should be on. Okay, fine. Others
Yes.
can keep it close. Okay, fine. And
Yes.
Parth, अपने भी photo दिखा दो एक बार. I mean, you can show your video.
Sir, I have joined via my laptop and the webcam is not working. Let me
Sure,
join
sure.
by
No
my
issues. No
phone and
issues.
I'll
Okay.
show you my face in a
Okay.
minute.
Okay. Okay.
Yeah.
Sarthak, go ahead, please.
Yes, sir. So basically, I'll tell you about what derivative instruments is and how derivative structuring works. So the first thing is that derivative is a financial contract whose value is dependent on an underlying asset. As in the value of a derivative relates to the underlying asset for a group of assets or the benchmark assets that comes under the derivatives. Now, we have around 5 to 6 aspects under it. First one is influence of underlying asset. So the influence of underlying asset states to the risk, pricing, and basic term structure for each derivative. That is, the risk, the pricing, and the basic term influences the underlying asset. Then we have purpose of derivatives. So the purpose of derivatives is used for various purposes such as hedging and gaining access to additional assets and markets. So the derivative helps us to gain access to over the other markets as well, and the other underlying assets that are trading in the other markets. Then we have asset trading. Asset trading is either in cash or spot markets, and its price is referred to as the cash or spot price. Whatever the spot price is, it is referred to its cash. Then we have diverse underlying assets. So diverse underlying assets includes the stocks, bonds, and interest rate currencies. Other than more adding more to it, commodities, credits, as well as unconventional factors like weather, electricity, and disaster. So, sir, the underlying assets are diverse because it takes into the account the natural and unnatural effects as well. So, the unnatural or technical effects are stocks, bonds, and interest rates, and the currency commodities, and the unnatural effects are the electricity, disaster, and the weather, and the other calamities. Then we have call option. Under this, call option is the right to buy an underlying asset, and put option is the right to sell an underlying asset. Next slide.
So just hold on, Sarthak. Let's go
Yes,
back.
sir.
So you talk about call option and put option. So call option, under what circumstances do you buy a call option? Just give me answer. That's all. कब खरीदते
Under
हो? When
what
you're bullish or bearish?
when we are bearish.
Call option. No, it's just
Yes.
the reverse. Call option is when you are bullish. Okay. When you think that
Okay.
the underlying asset will go up.
When the
Okay. No,
market is
no problem.
increasing,
No issues. Okay.
when
Please.
it is increasing. Then
Okay.
we sell it off when it is bearish, as in we take a spot price and we sell it at that.
Sure, sure. Go ahead. Next slide, please. कोई बात नहीं. I mean, it's always, people can make mistakes, so don't worry about it because this topic is such complicated. Okay, but you will understand after some time when you
Sure, sir.
start, trading or so then it becomes part of your life. Okay, go ahead, please.
Sir, actually, it is a blunder because I do trade, so that's why I'm sorry. Sir, we have the advantages of derivatives. So the first one is risk mitigation. So, sir, the biggest advantage that derivatives provide you is that it lets you mitigate the risk, and the second is price determination. It can contribute to the determination of underlying asset prices. So, for example, any spot prices in the future can serve as the estimator. So, for example, we have any future spot price, and so we can make the estimates of the price for a certain stock beforehand only. So, playing a role in establishing price benchmarks in financial markets. So, this is one of the important advantages, that is price determination. Then we have enhanced financial market efficiency. Derivatives are thought to boost the efficiency of financial markets through utilization of derivative contracts for replicating the asset payment. So basically, derivatives replicate the asset payments, and it helps you and it makes the market more efficient by minimizing the opportunity for arbitrage. Then the last advantage that I have mentioned is access to unavailable assets and markets. Derivative basically has the power to mitigate or access the assets and the markets that might be otherwise inaccessible for the general public. Sir, there are certain markets and assets that we personally cannot look into, but derivatives helps you to um, get the access through it and get to more about it. It lets the company secure low interest rates compared to direct borrowing and facilitating strategic financial management and also heads towards the cost reduction. Then next slide. So we have on the next slide, we will see about the overview of derivatives. So the overview of derivatives include the over-the-counter dominance, over-the-counter trading with exceptions of options and futures. Options and futures are exclusively traded on specialized exchanges. Now, there are three basic derivative types: forward future contracts, options, and swaps. So, forward and future contracts are basically agreement between two parties where one party commits to buy an asset from other at a predetermined cost. As in, we can set and fix the prices on a predetermined basis. Then we have standardized and trade exchanges. Then number three, we have basically forward and future contracts provide you more flexibility and allows you to customize the underlying goods. Then we have options. Option grants the buyer the right to buy or sell the underlying asset. Then it can exercise either either on the expiration date, that is European options, and before the expiration date, that is American options.
Okay, just skip now.
So
This is all theoretical. Okay, I understand. I mean, you've prepared it.
yes.
So this is all.
Next slide. Next slide.
Next
We'll
slide,
move
we
to.
आपकी है सार्थक.
No, sir. The next slide is not fine.
Okay. So who is going to present next?
Yes, sir. Devji.
Devji. Okay. Devji, आप कहाँ
In,
where are you from?
sir, Aurangabad, Maharashtra.
Maharashtra. Okay. ठीक है. Go ahead, please.
Hello.
So you are all what economic students or from which discipline are you?
Sir, actually, me and Devji are from economics and finance. Rest all are from BMS.
From BMS.
BMS, yes, sir.
What does that stand for?
Business and management studies.
Okay, so that's a BMS group basically. So you are from eco and finance, and they are just morely finance, isn't it? No.
Yes, sir.
Okay, ठीक है. चलो देवजी, is there any
Yes, sir.
problem with your mic? Okay, go ahead, please.
Introduction to hedging in international trade. Managing foreign exchange risk is crucial for international businesses navigating the complex and dynamic world of currency fluctuations. These fluctuations can significantly impact a company's profitability, asset values, and overall financial stability. Hedging emerges as a strategic tool to mitigate these risks and safeguard the company's financial performance. Next slide, please. Foreign exchange risk and its impact on international businesses. What exactly do we mean by foreign exchange risk? Foreign exchange risk, also known as currency risk or exchange rate risks, arises from the variability in exchange rates between different currencies. When a company conducts business across borders, it inevitably exposes itself to this risk. For instance, an exporter selling goods in a foreign currency faces the risk that the foreign currency's value might depreciate against their home currency upon receiving payment. This depreciation would reduce the real value of the revenue earned, potentially eroding profits. Similarly, we can see the case that an importer purchasing goods in foreign currency faces the same risk that the foreign currency's value might appreciate against their home currency at the time of payment. This appreciation would increase the real cost of the imported goods, potentially harming profit margins. The unpredictable nature of exchange rate movements can make it challenging for international businesses to forecast their financial performance accurately. Unforeseen currency fluctuations can lead to unexpected losses, hindering businesses' growth and stability. Next slide, please. Hedging as a strategic tool for mitigating these risks. Hedging strategies serve as a proactive measures to minimize the adverse effects of foreign exchange risk. These strategies aim to unlock in a predetermined exchange rate for a future transaction, effectively neutralizing the impact of currency movements. The common hedging instruments include forward contract, option contracts, currency swaps, natural hedging. Forward contract is a forward contract locks in an exchange rate for a specific amount of foreign currency to be exchanged at a predetermined date in the future. This provides certainty in the future of the foreign value, shielding the company from unfavorable exchange rate changes. Option contract. An option contract gives the buyer the right but not the obligation to exchange a specific amount of foreign currency at a predetermined exchange rate on or before a specific date. On is for usually European options, and for American it's before the specified date.
Okay,
This
go ahead. I
flex
mean, this is all what you're reading from the slides, okay, but it would have been better if you had just explained it, I mean, just a few liners without reading it. But anyway, no problems. Okay, I'll ask you. Next slide bhi hai koi?
Yes,
Jaideep?
sir.
Okay, just move to the
Yes,
next
sir.
slide. So we understand, there are currency forward contracts, options, currency swaps, and natural hedging. So that what
Yes.
we did in the course. So next, please, next slide.
Next slide, please.
Okay. Impact of hedging on
What?
international. Yeah. Okay, go ahead.
Yeah. The impact of hedging on international business operations. It reduces the exchange rate volatility. It enhances the profitability and improves the cash flow management. And it also strengthens the risk management. It reduces the exchange rate volatility because the main aim of hedging is reducing the exchange rate volatility and securing the firm's profits
Okay.
and okay. Next slide, please.
Am I audible?
Yeah, you're audible.
Yeah. So,
So is that Viraj now? Devji, आपका हो गया? Viraj, go ahead, please.
yes, sir, I'm Viraj.
Yeah.
So, in the dynamic realm of international business, adept management of foreign exchange risk is imperative for sustained success. Employing robust hedging strategies become a crucial tool to navigate currency fluctuation, ensuring financial stability, profitability, and growth of the company.
Okay.
There are a few cases of companies which like they use the hedging techniques.
Okay, just show. I think your voice has dropped a bit. Are you still speaking? I'm not able to hear you. Go to the next slide.
Sir, I think he's facing some network issues.
Okay. Are the
Currently,
slide? Just go ahead with the slides. Don't worry. I mean, if there is an issue, so just move on to the slides. Who's having the control of slides?
Biraj only, sir.
Acha. Okay.
1 second, sir. Give us a second. Sarthak, can you present? Viraj has left the meeting. I think there's some issue with.
Okay. No issues, chalo. Just again.
Yeah, just a second, just a second. Present.
Just a second.
So, is there any issue?
Yes, sir, just a second, just present. Just a
Sure,
second.
sure. No issue. So if you are having in some issues, just share me the slides. Okay, okay, you're getting it. Just try to conclude in next 5 to 10 minutes. Okay. I
Yes,
mean,
so just
Sure, sure.
can you to CF industries like I think so Viraj is not able to join.
no issues, no problem. Don't
Can you
worry. I mean,
try
ask him that
like what?
he can just relax. Okay, don't worry about it.
Yes, yes, sir, I will try to inculcate his part. So basically, I would first like to tell what CF Industries are. CF Industries is a company that basically operates in the fertilizer manufacturing industries. So talking about the hedging techniques of these CS industries. So they employ various hedging techniques to mitigate financial exposure to the natural gas price volatility, a crucial factor in the production of nitrogen-based products. So the company utilizes natural gas derivatives such as future swaps and option traded on exchange or over-the-counter markets. Additionally, the fixed price, physical purchase, and sale contracts are also employed to hedge against the natural gas price fluctuations. So, in order to address these foreign exchange rate risk, CF Industries occasionally utilizes foreign currency derivatives, primarily through foreign exchange contracts. So, important to note that the use of these derivatives may lead to the reported earnings volatility due to unrealized mark-to-market adjustments. So, particularly for the derivatives that don't qualify for the hedge accounting or to which accounting is not applied.
Okay.
Next slide. So these are the just basic like how the risks are involved during the hedging for CF industries. So it just overall summarizes that hedging arrangements are imperfect and unhedged risks are always that exist. Next slide. Like we would directly move on to this case of Boeing 747. So when a company has payables and receivable in foreign exchange, so just give me a second.
Sure, sure. This is also Viraj slide or your slide?
Yeah, so it's with Virat's slide only.
Okay. You can just skip. There is no issue. I mean, you can. I mean, present your slides. No issue.
Yes, if possible, just give me a second. Like I also read this part. Just give me a moment. Yeah. So in this case, yeah, you can skip this slide because it is just Viraj have joined.
Okay.
Viraj, can you just talk about the case of Boeing 747?
Yeah, sure. One second. In the case of Boeing 747, when a company has payables and receivables in foreign currency, it is exposed to transaction risk. It is the danger of the currency rate unexpectedly changing on the delivery date. Global payments might be hedged due to simple access to financial contracts. The payment resulting from access to globalization are a very other ballgame. Businesses send billions of dollars in overseas payment each year. These payments are made after weighing numerous possibilities to reduce transaction risk. Corporates commonly hedge their transaction exposure in three ways. First is foreign market protection, second is a financial market hedge, and thirdly, hedging in the options market.
Okay. You can. Who is
No,
going
so
to? Yeah.
now this is my part. So,
Okay.
talking about this, we have some Boeing is using a one-year forward market hedge to manage its foreign exchange risk on pound receivables. The forward contract is established at a rate of $1.46 per euro. So here's a breakdown of two potential scenarios that can happen. So scenario one, that is adverse movement for Boeing. So the forward rate is fixed at $1.46 per euro, and the maturity date is like if the exchange rate on the maturity date is lower at $1.40 per euro, Boeing has still locked in the higher forward rate of $1.46 per euro. In this case, Boeing forgoes the opportunity to benefit from the favorable spot rate, but it avoids the potential losses if the exchange rate has decreased. Talking about the second scenario, favorable movement for Boeing. The first was the adverse movement, the second is favorable movement for Boeing. So if the forward rate is at $1.46 per euro, that is the same. If the spot rate is higher at $1.50 per euro after 1 year, Boeing incurs a loss because it is obligated to exchange pounds at the predetermined forward rate of $1.46 per euro. In this example, Boeing loses $0.04 per euro or zero point 0.4 millions. So in essence, the forward market hedge provides Boeing with certainty regarding the future exchange rates offering protection against adverse movements. However, it also involves the opportunity cost of potentially foregoing gains if the spot rates turn out to be a more favorable than the forward rate.
Good.
So in this case, the forward hedge act as a form of insurance against unfavorable exchange rate movements.
Okay, very good. Next.
Next slide.
अब ये ठीक है ये who is going to present this? Shubh, you?
Yeah, I only, yes, sir.
Okay, no, for up next participant, I mean, whosoever is left now, I mean, I could understand all this, so I mean, so you can just skip this part, okay? Fine. So,
Okay, sir.
who is left now?
I think.
Shall I present
हाँ,
some
Surya?
summary of general techniques that are used by Indian companies for hedging foreign currency risk in transactions for payables and receivables? Next slide, please. We look at examples of Tata. So Tata for their fiscal year in 2022 utilized their currency derivatives and forward contracts to hedge its payables and receivables against the potential currency fluctuations, and they could minimize the impact of adverse exchange rate movements, and that contributed towards a more stable financial performance for them. Next slide, please. So for Infosys, since it has it has a significant international presence, Infosys also faces forex risk due to revenue generation in multiple currencies, and it employs a sophisticated forex risk management framework utilizing a combination of currency swaps and options. Infosys strategically hedges its forecasted transactions, including sales and purchases, for up to 18 months. This approach has been proven effective for them, as evidenced by companies' improved forex gain of INR $1,200 million in the financial year ending March 21st, 2022, compared to their $500 million in the previous year.
Okay.
Next slide. We have Hindustan Unilever Limited. It is a leading consumer goods company. So basically, the company's hedging strategy aligns with its business goals and is regularly reviewed to adapt to changing market conditions. In the financial year 2022, HUL reported a forex gain of humongous INR 800 million rupees, and demonstrating the effectiveness of its risk management practices. Next slide, please. Then we have Reliance Industries. It is a diverse conglomerate, engages in global business activities, making it susceptible to forex volatility. So basically, Reliance hedges its exposure for a strategic period. It is very different than other entities. It often leads up to 2 years using a mix of forward contracts and currency options. In this approach, it got a forex gain of INR 3,000 million rupees in the fiscal year, which ended on 31st March 2022, compared to its previous year gain, that was 1,200 million rupees. Next slide, please.
How many slides are left now?
So last slide. This is the last slide. ICICI Bank also hedged, and it gained a forex gain of 2,500 million rupees, showcasing the effectiveness. So, sir, the inference out of all this is that Reliance was able to capitalize its forex gain because it had various entities working on it. So this is the way we presented, and my future prediction for this is that under this, the forex gain for Adani by next year will be much greater than any of the Indian companies on board. Thank you so much, sir.
Chalo, great. So you people have done a good job. Okay, fine. So you all learned this forex for the first time in your studies, or earlier also you were having some knowledge about it?
Sir, we had one or two courses, but this gave in-depth insight for these concepts.
But for the BMS, like it was the first course for us, like to go into the deep and study about these foreign exchange reserves and all these. Like, yes, sir.
So what else? Anybody? I mean, so it was a good learning for all of you. I mean,
Sure, sir. Yes, sir.
ठीक है
Yes, sir,
चलो.
definitely.
Yes, sir, it was a great learning experience.
Okay, good. So we'll close from, now. The other group can just join, and we'll start after a couple of minutes. Okay, so you can ask anybody who has come from the other group. Tejas.
Yes, sir.
Okay, okay. So rest of you can just leave, and the new group can be there. Okay.
Thank you, sir.
Thank you, sir.
Okay. All good. All the best. So